Welcome to today's monthly market update. I'm Craig Fuller here with Anthony Smith, and we're going to talk about what the data is telling us about the freight market.
That's right.
Welcome to the monthly update, Anthony.
I'm excited. I'm a longtime listener. Happy to be
big
on.
fan.
Big fan.
A long-time listener, first caller.
Yes, exactly.
First-time caller. Well, excited to have you. You've got a background in economics, and we're going to talk about that. You actually did a lot of work around the construction and materials industry.
That's right. That's right. I was in-house economist for a building products company most recently. And a few years general economic consulting, a lot of forecasting for various amounts of different industries, retail, manufacturing, industrial, run the gambit.
All the stuff that moves freight.
All the stuff.
We're excited to dive into it today and really go into what's happening in the economy. It's been a ton of news.
Yes.
It feels like, every time we do this webinar, I talk about the fact that I think trade is settled.
Okay.
And now I'm going to say it is not. I predict within the next week, there'll be another major tweet that will impact trade. Is that a fair bet?
That's a fair bet.
Okay.
That's a fair bet.
You're not going to take it, huh?
I can't.
All right. So we'll get into it. But regardless of where it ends up, we know there's going to be a lot of stuff happening in the economy. There's a lot of concern and angst in the broader economy. We've been seeing some softness in the past, but now there's encouraging signs. We're going to get into it today.
Right. That's right.
So really excited to get into it. A little bit about FreightWaves is that we built this community to analyze data, technology, combined with tribal knowledge to analyze, forecast, and then help companies and participants de-risk the market. I've got a team of actually over 30 full-time journalists now that are involved in the markets and all elements. We have a team of data scientists that are out crunching the data, and we're talking about the economy. And this is right in your lane. So excited to get into it. I talk a lot about the fact that we've used data and combined it with tribal knowledge. And tribal knowledge means experience. We're able to use and interpret stuff that's happening and understand where it's headed. And we're going to dive in this today. The agenda for today is really to look at the recent freight economic performance, which is quite different than the broader GDP numbers, because only a portion of the GDP actually is related directly to freight. We're going to look at the second half of 2019. We're going to talk about retail and e-commerce because we're headed into retail peak.
Right.
I'm optimistic.
Good.
So I'm optimistic about where that heads. And then we're going to dive into recession fears, which are actually there's some grounded elements to whether or not the broader economy is going into recession and whether or not the freight market may have seen that and gone out of it. We'll dive into that. And then we're going to go into just the global economic slowdown, which is actually a big X factor. And then we're going to talk a little about interest rates. We have a full agenda.
A full agenda.
I love it. Let's get into it. So you've got your comments.
All right. So as the summary says, we're going to start with manufacturing. I think that's a huge driver of freight. And we're going to get into that. Trade uncertainties, I think that's almost standard as of the last few months or so. It's almost standard. Of course, interest rates, also a big aspect, and consumer trends.
Yeah, it's a big impact. And then I'm going to basically say, and I've said it before on video, the freight recession has ended. I'm calling the end of it. We're done.
Here we go.
For now. Now, I would say that was before the last set of tweets. So that may be the factor here, but we're not seeing any reason to be concerned yet, but we'll see where that heads. And then also we're seeing signs that capacity is tightening, which I think is a really good thing because that's going to drive the rest of the market. And really our outlook is really for the third and fourth quarter. It's hard to know at this stage what next year is going to look like.
Right.
And it's just tough because the market is so opaque and there's so many factors that could impact freight demand in 2020. We have pretty good insights and pretty good views on the rest of the year, but we'll dive into that.
So just as you mentioned, GDP. As you mentioned, so big part of GDP, not all of it relates to freight. So what we have here is the real goods GDP. So this takes private final demand goods, focuses much more on the freight component. And as we can see in 2016, I believe, would you call that the last freight recession?
Yes, 2016 was actually the last, what folks have said it was the last freight recession. Looks like we're about where we
were. So with the most recent numbers, we can really clearly see that we were kind of within that range where we were in 2016. Other than that, we saw, of course, strong freight growth, and was 2018 really we saw that peak, and it's just been kind of on a downward trend since.
Yeah, 2018 was a great year. Now, part of it was not just the fundamental demand in the economy, but also you had this import pre-run up of tariffs that were also existed. So certainly driving it.
Right. And so one of the big things, so what we're looking at now is outbound tender rejection index and the industrial production for manufacturing. So, of course, on the macro level scale, as an economist, I love to look at the month-to-month trend. So one of the things that we see here in the orange line on this chart here is that we have the industrial production for manufacturing outlined here. One of the great things I love about Sonar is that we don't have to wait month to month. We can see that there's a clear correlation here between the outbound tender rejection index and the manufacturing index for industrial production. So one of the things we're seeing here is that we're off to a slow start in the third quarter. I like to look at and make these comparisons because the industrial production manufacturing side of it is almost like a good diagnosis when you can kind of see, okay, there's a correlation here, but it's on a month-to-month basis. It's good to kind of look back and confirm, okay, this is where some sluggishness came from.
Yeah, manufacturing declined in July. Right. So what's driving that, do you think?
I think a lot of it is going to come from business uncertainties, business investment uncertainties. I think as we kind of talk about trade, we're going to get a lot of headwind here coming up shortly. But I think in the next one, we have the Purchasing Managers Index. Yes, we do. So we have flatbed tender rejections and the ISM Purchasing Managers Index. So preliminary reading for the PMI, we had a 49.9. So anything below that 50 is indicative of contraction. And that's the first time it's gotten below that in almost a decade.
So really negative sentiment for PMI. And you see that in the flatbed data, a high correlation between flatbed data and PMI, which is suggesting that demand is really heavily correlated between the two. And so we're seeing that both flatbed demand and ISM is dropping off. In terms of what's driving that manufacturing sentiment and the softness there, is it just related to tariffs?
A lot of it's related to tariffs. We did have a little bit of some strength earlier on in the year, and a lot of that just came from general business seasonality. So tariff fears weren't enough to really offset that. But as we kind of get into the thick of it now with the latest tweets, we really see.
Well, it's hard to know because the problem is that you go out and you feel like the market's stabilized and you're going to make these investments. Right. And then you get a tweet that completely changes your view of where things are headed. I mean, that creates a lot of stress. And it's certainly showing up in the PMI data.
Exactly.
But it's interesting because I think that what we're seeing around, the flatbed market has been really, really tough this year. Definitely. And I think it is so correlated to manufacturing. And manufacturing really in the United States, a lot of it is related to energy. A lot of it is related to materials, as you know well.
Right.
And so that's certainly showing up in the data.
Definitely. I agree. One of the other aspects we see, so on the more consumer side of things, consumers in a good place. We can talk employment all day. Employment's at, strong numbers for employment. The confidence is still relatively high. We're going to touch on that a little bit later, shortly here. But what we're seeing is that when the consumer is in a good place, we're seeing some overlap and some impact on freight volumes, especially when we're looking at LTL and goods being demanded. So when we're looking at consumers feeling good, feeling confident, wages are in a good place, they're going out there, they're buying stuff that needs to get transported via freight throughout the country. And this is really going to also call for more drivers to take that stuff around the country.
So retail sales are strong. You seeing any reason to expect that to be soft? Or?
I do. So nothing in the data jumping out just yet. But in my economist mind, I turn on the TV. If I'm not an economist or if I'm not following the markets and I see recessionary fears left and right, I might start saving. I might be less inclined to start buying. I might be less inclined. We're going to look here shortly to buy a house, even if I'm in a good position. Looking at the LMI, this is something that is similar to the PMI. It's going to look at the logistics side of things. And we can essentially think about this as shipper sentiment. Really what we saw early on and kind of ticking up here was some real strong support coming for warehousing. So this is a newer data set that we're bringing in, and that I'm really excited to start drilling into this and drawing in more insights. But just kind of want to introduce this one real quick to kind of get it out there. But we're looking forward to using this one. This one is the composite measure. As I said, it gets broken down into a few different other areas, warehousing being one of them. I know there's a lot of strength coming from that. And I think a lot of that's going to be coming from just a general trend from e-commerce.
Yeah, so Logistics Manager Index is a combination of 4 universities that actually are taking in and doing surveys of logistics managers, and they're actually looking at where how logistics managers are either confident or lack confidence in the overall sort of state of the logistics market. And what you can see is we're actually in 2019, it's been pretty low. Right. And so 50 means that they're confident, below 50 means there's a contraction. So there's an element here in terms of just not a ton of bullishness in with the LMI.
That's right.
And so it's interesting to sort of watch how that actually plays into the broader market.
Exactly. Housing construction, what kind of market expert for housing construction would I be if I did not include a chart in here for housing starts? What we see in the housing starts, the latest data showed that there was a decline. A lot of it came from the volatile multi-unit housing starts, while there was a small uptick for single unit starts. Same thing here. So mortgage rates are still at historical lows. Consumers are still relatively feeling confident. That sentiment is still high. But as I mentioned earlier, even if you're in a good place and you have, your wages are well, job security, all that good stuff, if you turn on TV, you see recessionary fears, you might be hesitant to buy a home. Now, there are still other factors at play here when we're looking at housing starts, things like builders not being able to find enough labor to put these homes up. There's a shortage of entry-level homes, which is in high demand. And on the existing home side, the inventory is very tight, very much a seller's market, so to speak, if you're looking at entry-level homes to mid-level, mid-sized homes to really kind of draw in those buyers.
Yeah, and housing is a huge driver of freight demand, right, between construction of new homes as well as when people buy homes, what furniture they put in and other things. It actually drives a lot of the freight demand.
Definitely.
So moving into the freight market update, we're going to dive into the fundamental data related to what we're seeing in the market in terms of what's happening. This is really what I go to. It's my go-to index inside of Sonar. This is our outbound tender volume index, which measures the total amount of requests for loads. And so these are tenders. It's measuring about 85% of the tendered transactions, electronic tender transactions of the market. And here is what I see. And this is, I'm excited. The reason I'm excited is, when we were here in mid-May, there's a sizable drop-off. So we're comparing 2018 and 2019 numbers. The yellow line is 2018. The blue line is 2019. In mid-May, we saw the volume really fall apart. In fact, these other dips that you see, the one that happened between April and May was Easter. We saw the big dip in May really related to a slowdown in the freight market. And that's what really gave us a pause. It run countered cycle. If you look at 18, you saw an expansion in volume. 19 was soft. And really the market was, for most of 2019, has been softer than 18. And even in some of these big dips were even more so pronounced. But moving into July, about mid-July, we actually saw the opposite. We saw the lines cross. A technical analysis person would say this is a golden cross, but we saw the lines cross in mid-July. And guess what? We're finally at a point where there's expansion. What's really exciting about that is if you look at August 2019 in terms of volume, is we're up about 6.5%. We peaked of about 6.5%, 6.3%, sorry. And we're actually about 3% more volume. So that's good. It's not a function of capacity. Again, this doesn't measure capacity. This measures volume. And it's suggesting that the freight market, as it relates to domestic trucking, is doing better than what we saw in 18. So I'm really encouraged by that. Moving into some of the just movement of cargo and how cargo is moving, it looks like the East Coast is becoming the big beneficiary of the 2019 surge. Where we saw a lot of volume into the West Coast as companies were planning their supply chains around Asian imports and how to prepare for this long trade war with China. the West Coast were beneficiaries last year and earlier this year. This year, and going into the last couple of months, we're seeing the opposite. We're actually seeing the East Coast start to pick up in terms of demand. Volumes are up 24% during that period of time. So we're seeing really strong demand on the East Coast, which I think is exciting. But it also suggests something really important, which is that a lot of what's happened on the East Coast is consumption oriented, where products are moving into the East Coast and consumers are consuming them. There's also a problem of warehouse space on the West Coast as products have been shifted in there and stacked in places like San Bernardino and Ontario, California. They just don't have sufficient warehouse space. So they're moving a lot of that freight to the East Coast. And I think that's really encouraging for a lot of the trucking market, because really the West Coast, with the exception of those long haul truck drivers, a lot of that goes on intermodal. And what we're seeing now is, as it's hitting the East Coast, it's really benefiting a lot of the domestic, the over-the-road trucking market. Moving into customs shipments is that we have seen imports elevated year over year. And of course, it's been feeding the volume domestically. I think, looking at where things are at is there's been a near-term dip, but I don't think that's necessarily a bad thing. There's so much freight sitting in inventory in warehouses that moving into the rest of the year, there'll be a lot of a cargo movement for peak, and people are trying to clear out their warehouses. So what I think we'll see for the rest of the year is we'll see strong fundamental volumes in the trucking market and the broader freight market really through 2019. And then the question is going to be what happens in 2020. So we'll see it. There's also a seasonal short-term drop really related to shipments in terms of imports. The question will be, what does the third and fourth quarter in terms of October, November, December hold? I don't know. Going into in terms of which markets are actually strong in terms of year over year, Ontario, California is actually much stronger. You do have to be concerned. Ontario and LA, West Coast has been good. Houston, of course, has been port oriented. Newark. So the big port cities are doing much better than parts of the sort of core manufacturing parts of our economy. So Atlanta is actually down. Dallas is down. Harrisburg, PA, is down. Joliet, Illinois, which is a big railhead, is also down. That's not just Chicago. But it's interesting because you're actually seeing this big increase in freight volumes in terms of coming out of the port cities and big decreases in the major inland markets. I think that's sort of reflective of what the freight market looks like. And it sort of suggests that what has been keeping high demand is really related to ports. We also have to talk about spot rates, because spot rates have always get attention. And I think this is a really interesting chart showing the year-over-year spot rates. The big yellow lines were last year, were the 2018 freight market. We're in the sort of mountain blue is what I would call it. And really matching up to the 2017 in terms of spot rates. And so that's, that suggests that what's happened with spot rates is they're following a more normalized pattern. They're slightly ahead of 2017, which, if you look at that, that's somewhat encouraging, right? Spot rates have not collapsed. But right. I would say we have to be cautious to draw conclusions, because what we haven't factored in those numbers is the effect of cost increases that have been borne by the trucking industry during that period of time. And this is really demonstrating that right here. So one of the indexes we get is the operating ratio index on TCA data. Operating ratio, Anthony, and as you know this, is that this is the opposite of profitability, or it's the inverse of profitability. Remember, a high OR is bad. So you, as a trucking company, you don't want a high OR. That means you're actually in worse shape. And 100 means you break even operating. You hadn't paid your bank and you hadn't paid your taxes, but you broke even. Right. And so if you have no debt, you're okay. But everybody in trucking has some debt. And so you want a low OR. A low OR is really healthy. What we've seen is, even considering that spot rates are about where they were 2 years ago, and volumes, if you look at the CAS index, are relative to where they were 2 years ago. And this is the common argument people make when we talk about softness in the market, they say, well, this is just like 17. How do you compare 18? You have to remember that costs increase double digits in that period of time. Fuel prices are higher, employment costs are higher, your cost of capital is higher, you've got equipment cost higher, everything's higher in this cycle than it was 2 years ago, and that's why that operating ratio looks pretty poor. In fact, if you compare 2019's numbers to the past 5 years, trucking companies have had the worst first half of the year since they've had in the past 5 years, and frankly, since we've been or since TCA has been collecting the data. So it's really concerning, and it really suggests that a lot of that bloodbath conditions that have been written quite a bit, we've talked about it, has some foundational proof, and also it also would suggest if things do get worse, which I don't think they will, I'm actually pretty bullish, then a lot of those companies that are teetering on profitability or teetering on going bankrupt could push them over the edge. Move into diesel, because we did talk a little bit about the cost of diesel and sort of where things are at. If you look at there's a high correlation. This is the WTI, West Texas Intermediate, versus the Department of Energy diesel price per gallon, which is the retail assessed price by the Department of Energy. Basically, what we're seeing is that diesel prices since last year have dropped. And the dropped, looks about, if you look at where it peaked at $3.40 a gallon, down to about $3.10. Again, this is the retail price. This is not the wholesale price. So if you're on a wholesale rack price, you're in better shape. And frankly, the spreads have gotten bigger. We'll talk about that in a second. I think the big question that we have to consider or have to think about is, what is the impact of IMO 2020 on the retail diesel market? Because this new emissions and environmental regulation is going to go into effect in early 2020. And with that happening, what happens to diesel? And I think, I was talking to a shipping expert today, and they said no one really has a plan on how to handle it. Or no one really knows, I should say. There are people planning, but no one really knows what is happening. Now, the other thing to watch is WTI. We're not seeing any level of increase in terms of the price of WTI or oil prices. So that should keep diesel prices within a range, exception of IMO 2020, if that has an impact. We'll watch that and see where that goes. Getting back to talking about spread, because this is the retail to wholesale fuel spread, you can see since really the summer that spread has actually expanded. If you go to the first part of the year, we averaged about 93 cents a gallon in terms of spreads. We're about $1.05. So we've seen it about 13 cents higher during that period of time. Now, part of that is there's been a couple of states that have taken tax increases, which is actually probably related to about $0.015 of that. But I think this is sort of suggests that the larger asset-based carriers are benefiting from the higher spreads. They're benefiting on the wholesale market from lower cost of diesel at a time when retail prices have stayed fairly stable. So it's something to watch and something to keep in mind that it should be benefiting some of the larger publicly traded carriers in the latter half of the year. Now, the question will be is with IMO 2020, if you see high spikes in diesel prices, do the spread hold or does it go away? I mean, the truck stops are reluctant to lower prices. They like taking them up, and they'll be much faster to take them up than they are to down. So moving into capacity indicators, because this is also gets brought up a lot, is this outbound tender reject index that we've built, which is really a function of measuring capacity. And it also really fundamentally measures the willingness of a carrier to accept a load that has been offered to them. And what we see is that it sort of bottomed out and, it peaked in terms of rejections at 6%. Now, I want to keep it in mind that 6% looks high on this chart, but if you go back to last year, we were at 25 to 30% rejection. So much, much higher. We did see rejections really through that summer peak, the typical summer, June peak cycle. We saw higher rejections. We saw it fall apart in August, and that's really why a lot of the carriers were talking about how soft conditions are. But we've seen it bounce back, probably related to volumes more than anything. Just the fact that volumes are starting to pick up, and because volumes have picked up, now we're seeing some firming of capacity. You can also see this in terms of just where things are at in the refrigerated market. The refrigerated market has done much better as a freight market than the van market. You see it in the public. Martin is a publicly traded refrigerated carrier that had an exceptional quarter, and a lot of it's because when you saw the capacity increases last year, really wasn't as much in the refrigerated market because they didn't go buy new boxes. They didn't buy new reefer trailers. A lot of that was in the dry van market. This year, that sort of kept capacity in line, and we've seen rejections increase. But, of course, these markets do follow in tandem with one another. It's just that the refrigerated market tends to have tighter capacity, and a lot of that is going to be related to what's happening. Now, weather, of course, has an impact on this. It has been very, very hot this summer, and because of the weather, that's kept. Actually, refrigerated does better when the weather's better this part of the cycle. It does worse when there's no produce to move, but when you have really hot seasons, then it does. People need to keep their beverages and other things within a tight band. Moving into tractor counts, I think this is really interesting. A new index that we rolled out talking about expansion. Now, one of the things that we get asked quite a bit is the assumption is that most of the market is small trucking companies. In terms of fleet counts, that's correct. But in terms of distribution of capacity, that's not actually correct. Is that actually the distribution of capacity is much more evenly distributed through these cohorts. So you see distribution in terms of expansion. And what we're actually seeing is that the larger carriers have been far more disciplined in terms of their fleet counts than the mid and small guys. And so we're seeing that the small guys are still adding, and the mid-size carriers have, relatively stayed flat. The big guys are not adding capacity. They've been much more disciplined in this cycle than they have in years past. What they're likely doing is replacing their older tractors with some of the newer tractors that they are adding, or being far more disciplined in adding fleet counts. Plus, there's been a ton of M&A, and what you see with mergers and acquisitions is that we saw one yesterday with Heartland, is you'll see that carriers will start to downsize their operations because they're trying to optimize their networks. And that also plays into this. Moving into intermodal containers, talking about where things are at in terms of rail volumes. I'm going to introduce Henry, who's joined us. He's our market expert on trade. Henry, what do we got here?
Well, we have some good news on the import side as far as loaded containers for imports. West Coast volumes, even though in July they're showing slightly down at some of the ports. And that leads into obviously the total intermodal container count. And right here we're seeing a small decrease. I specifically not dealing too much in the intermodal segment, but we are seeing volumes decline year over year in terms of the loaded volumes there. We have some data coming into Sonar very soon that's going to give a lot more clarity to this information.
Yeah, it's interesting. And of course, Tropical Storm Dorian. Is that how you say it?
Yep,
Dorian. So it's, hurricanes are an X factor. They are the black swan events of the freight market, because a major hurricane, a tropical storm, can completely disrupt everything we've talked about.
Absolutely. There's a lot of ships coming through the Panama Canal and heading right through that area. So it could cause quite a disruption. I don't know if you remember that Tote Maritime ship, but it completely took it down.
Yeah.
The one going to Puerto Rico.
And if it hits hits Miami or Eastern Florida, that also will have a profound impact.
Absolutely.
Florida's the most prepared state in the country in terms of dealing with disasters. It's also a very densely populated area. Last year when the hurricane hit the Panhandle, it didn't do a lot of damage in terms of actually causing disruption, because it went through a very loosely populated. But that southern part of Florida is very, very densely populated.
Yeah, so Port of Miami handles a good bit of volume for sure.
Yeah, if that hits, that could create a ton of run-up demand in terms of preparation, and also some secondary demand in terms of rebuilding. So hopefully, for the sake of Florida and really everybody, we don't see anything dramatic there. Talk a little bit about air cargo rates.
Well, there's the protests in Hong Kong are having a pretty significant impact on air cargo. There was also a typhoon that went through, Ningbo and Shanghai. They handled a good bit of volume as well. But air freight overall, we're seeing it's down significantly. I think you've even mentioned that a few times in some different posts. But
yeah,
not looking so good on the air cargo
3.4%
side.
year. If you look at sort of May year over year, it was down 3.4%. And of course, some of the later reports actually are showing more fundamental softness. But that's really related to just the global freight market starting to soften, and really the global economy starting to soften, which is really dragging down air cargo and air cargo demand.
Absolutely. All right, so this is China to U.S. container rates. The big key point here, I have these overlaid, really this year's rates versus last year's rates. And what I want to point out is that, in August, rates did not increase like they were expected to. And I think that's a little bit of a hangover from last year's pull forward. Demand just wasn't quite there initially heading into this peak season like we would have expected. And rates, year over year, we're seeing they're about 36% down on the West Coast. And then from China to the East Coast is down about around 21%.
Is that suggesting that shippers are not doing the kind of pull forward they were last year?
Absolutely. But the volumes are still there, interestingly enough. Trump did come out recently and order, U.S. companies out of China, whether they'll.
He can't do that. We live in a democracy.
Exactly. But they, you would expect to see some reaction to that. And I think, overall, just there was so much volume that came in during Q3 and Q4 of last year. It's just had such an impact. Like you mentioned earlier, a lot of that went into warehouses, and just throughout the whole year, this year, it's just kind of slowly been moving out into the system.
Yeah, so I was talking to Prologis, and this has been a few months, but they were talking about sort of optimal utilization of their warehouses, 85%. They're in the 92% of utilization. So they said at some point what ends up happening is that freight's left inside the hallway. It's unfunctional. Like the more freight you put into a warehouse, the more unfunctional that warehouse becomes, because you can't move and it's not optimized for efficiency. It's just putting stuff in there. And they said they've seen highest utilization. Now, I suspect, and I haven't talked to them in the last couple of months, but I suspect that some of that freight starting to trickle out.
But one thing I will point out is that since rates have not increased in August like they should have, I'm expecting a significant increase on September 1st, because I have sources that are looking at origin. They're telling me what's going on overseas in China at the origin ports, and demand is picking up. It is expected to be a big holiday retail season this year.
Yeah, absolutely. I'm bullish on the state of the freight market moving into the holidays as well.
Me too. So this is really interesting. The Port of Long Beach and Los Angeles, I wanted to point this out because together we have these combined, because we feel like that's important, because these two ports are really, a major gateway into the Los Angeles, SoCal trucking market. So we have these volumes combined, but if you look at the actual loaded import TU statistics, Long Beach is actually down, but Port of Los Angeles was actually up enough to, they actually posted like a 0.2% increase in volumes year over year for July. But I think the big story here is obviously looking to the East Coast ports. Like you'd mentioned earlier, the trade wars really played out in a way where companies are moving manufacturing and sourcing further into Southeast Asia, places like India, Pakistan, Vietnam, Malaysia, Indonesia. This is having a significant impact on the ocean routings for these ocean carriers. It's actually becoming, a better option for a lot of these guys to route via the Suez Canal instead of what historically would have been the Panama Canal. And we're seeing that play out, in real time here, not only in the U.S. customs import data that we're tracking, but in the loaded TU data as well, with Port of New Jersey, Port of New York. Those are basically combined as one port authority. They haven't released their official July statistics, but in tracking that data, I expect that to be up, and we can monitor that and see if I'm right. But Savannah's obviously posting a significant increase. I think it's 12%.
So Henry, I'm just curious here, because I don't know enough about not as much as you do, but is a function of moving through the Suez Canal a function of container lines having predetermined routes, or is it just faster to move through the Suez Canal to the East Coast?
It becomes, there's a few things. I think the drought this year in the Panama Canal had a bit of an impact, but there's also, considerations like the IMO 2020 coming down the pike here. So it's really one of those things where, ocean carriers while they may not be predetermined during the year, they're adjusting kind of where, these importers are moving to and where the volumes are. And they can do that, quicker than you would imagine. They can actually do that, during the middle of the year if they choose to.
So is it a geographical element? It's just faster to move it to the East Coast?
Absolutely. But I think that, there's always that risk of the Suez Canal and the geopolitical instability that could, possibly be there. But right now we're seeing that as a very real option for U.S. importers.
So moving into the summary, freight volumes in the domestic market are up 3% higher than last year. Capacity is tightening, but much softer than 2018. And really, 2018 was a banner year, but the softening for capacity actually started in April of last year. We don't have that chart here, but capacity started to loosen a little bit. The peak in capacity was that first quarter. Supply chains recognizing in the wake of a continued trade war that they have to rethink their domestic trade patterns, freight patterns. And we've talked about that. And then, of course, the hurricane season is about to peak. If Dorian hits Florida with force, then that could have a pretty big impact on what happens in the month of September. And I remember September was always a big month in hurricanes when I was doing relief. It was pretty sizable in terms of what we'd see. So I think now we have time for Q&A.
Awesome. Hey, guys. Marianne Hensley here with FreightWaves. First question on LTL carriers. What's your take on recent closures this year, as well as union carriers, YRC and ABF? You see them having issues with a slowing economy.
Yeah, I mean, I don't want to get into specific company issues just because those are two publicly traded carriers, and I'd hate to sort of look at it. I mean, YRC is the weaker of the two between ABF, Arkansas Best. So Arkansas Best seems to be in a much healthier position than YRC. But having said that, in terms of freight volume LTL, LTL is not as dramatically impacted in a capacity build as what truckload is. Truckload's far more volatile and is far more exposed to build. LTL carriers have fixed networks. They don't tend to add capacity inside their own networks as fast as what truckload carriers do. They will go out and buy purchase transportation to sort of supplement their LTL operations. And so we don't see the types of run up in demand. I think as long as retail stays strong, and it looks like moving into the fourth quarter that GDP will be relatively strong and the retail season will be good, I think LTL will be well. LTL also tends to be more resilient in a downside of the economy because of the fact that the shipment sizes get smaller. Truckload's the first thing to go, and people are moving stuff more through LTL because it's just frankly the shipment sizes are smaller.
And next question, please discuss the Savannah port and growth. Where do you see this going?
Well, Georgia Ports has just been doing a phenomenal job. It's obvious they're posting record months. It seems like every month now. With the way they're building the inland rail connectivity, they're able to reach a vaster part of the country. You can see that in how a lot of importers that are in Kentucky, Ohio. I mean, those people are Savannah's becoming a real routing option for them, especially given the fact that a lot of these U.S. companies are now sourcing from places like Pakistan, Bangladesh, and the west coast of India. Therefore, it just makes more sense to move it in that way. If you can think about how the port of LAX, historically with the Trans-Pacific eastbound has been, a very real option for moving it via rail to inland locations. With these vessels moving the opposite route and going through the Suez Canal, it's I think that trend's likely to continue. But the way that Georgia Port operates is also a little different. With the way there's not so many private terminals there. It's kind of a quasi-government entity, so they're able to do some things and change things quickly, and that's going to lead to increased volumes there. And you have just the Southeast in general, just kind of blowing up as far as people moving to the Southeast. And one outlier would be the auto industry and the trade war. That I think we've talked about that a little bit, but that's something to kind of keep an eye on because people like BMW, Hyundai, Mercedes. I mean, these people, rely on these ports for exports to China, and I know Craig's maybe mentioned that a couple of times, but that's just something to maybe look out for.
Yeah, I mean, Georgia, I think about sort of the investments they made in freight, with the rail going up to just south of here in Chatsworth, as well as the dedicated highway that they're proposing to build around Atlanta. They have made a significant amount of investment. And so they're, and just like you said, population center as it moves further south, that certainly benefits Savannah.
Okay. Next one's kind of an observation that I think they want you guys' thoughts on. It says more freight at 2017 spot rates with much higher costs baked in to support shipper capacity in 2018, plus a little trucker greed in the highly fragmented OTR market means that many trucking companies are in a big hole and any big negative change will kill them.
I agree. I mean, it's interesting because I spend a lot of time around the trucking industry, probably more so than the rest of the folks on this call, in this room, I mean. And I completely agree. I think there was a sort of sentiment last year where let's get it while we can, let's get as much of it. And when rates were good, everybody was bullish, but I think everyone got a little greedy. And I don't think it's a bad thing. I think now it's the opposite, is that shippers and brokers are taking advantage of the carriers by, the market has not supported high rates, and they're responding to the market conditions. And I think you can either begrudge the conditions of the market and hate it when carriers charge high rates because they can get it, or begrudge the shippers or brokers when rates are soft and they're not paying as much. But it's the market. Welcome to trucking. It's 101. I think as we think about companies teetering, I think a lot of companies last year raised their driver pay to a significant level. Some of them double digits. I talked to a company that had gone up 28% in 2 years in terms of driver pay. And unfortunately, you can't retract those payments. Now, I'm all for drivers getting paid. They deserve it. They do hard work, and it's needed. But the challenge is when you lock in those higher driver salaries, you're going to end up paying them indefinitely. And so because of that, it's more tough, and that's why the operating ratios are showing less favorable conditions for carriers. And so I think going into the rest of the year, if the economy does soften significantly because of trade or because of consumer confidence, that certainly could push some of the more marginal carriers into bankruptcy or liquidation. And we've seen that in LTL. We saw that with LME, and we saw that with New England Motor Freight, and that certainly could be the conditions for some of these other carriers. I think broadly, the larger carriers are not as exposed to the market. Most of them, particularly the public guys, are not as exposed as some of the mid and small guys. Those are where I'd see most of the pain. But we've seen some big guys fold this year as well.
And next question, it says, can you speak to the OR index in terms of how it's built and how you adjust for revenue size to interpret individual returns to the index?
Yeah, that's a great question. So that index comes from the TCA benchmarking data of about 220 fleet profiles. They've been accumulating it since 2015. So the Truckload Carriers Association runs a benchmarking group that brings in carriers that submit basically general ledger data to show how they're operating. So it's really the only a data set that I know of that provides monthly KPI indexes of about 31 different major data points. They actually accumulate about 500 data points, but 31 of them are published on an anonymized basis. It's all aggregated from both the top performers as well as the weaker performers. So you're getting an average. I think it's more reflective of the market conditions because you're going to have, even in soft markets, you're going to have really exceptional operators that are always going to do well. The public guys like Knights and Heartland always do well regardless of the market. And then other weaker carriers don't do as well. And you can see that in the public markets. But in the TCA data specifically, this is coming from fleets of about 75 trucks. I think the largest is 7,000 trucks that aggregate about 70,000 trucks total, and is showing 220 fleet profiles. And that's what that is basically, is an operating ratio. You can actually bifurcate it if you're a member of the benchmarking group. You can bifurcate it by fleet size based on your cohort. But for the purposes of this data, we don't. It is bifurcated by mode. So refrigerated, flat, and truckload.
Great. And what are you forecasting for flatbed carriers for the remainder of 2019 and into 2020?
Yeah, flatbed's going to be tough if housing continues to be struggling. I mean, interest rates, Anthony, have a big impact on, or have historically had a big impact on mortgage and housing sentiment. But I think, frankly, um, the flatbed market is really tied into construction.
That's right. So I think with flatbed, just like you mentioned, it's going to be a lot of tie-ins with construction, building materials. We're seeing lumber. And even another aspect, even if houses aren't going up, the larger segment, existing home sales, when folks are doing remodeling jobs and we're having those building materials moving across the country, that's going to be another driver of flatbed. But the thing is that inventory is so tight. Not a lot of people are selling. And those that are selling, it's just getting taken right up off the market.
Yeah, and the question that I have is if we sort of assume that the broader part of the economy is not as strong, at some point consumer sentiment could change, and that will certainly show up in the housing data first, right? Because
Right.
it's one of the first. People aren't making big purchases if they start to lose confidence in the economy.
Right. I think we're definitely going to see that in the housing. It might not be as pronounced just because it's been so lackluster as of late. If we start to see those retail sales numbers start to come down, decelerate, that's when I think, okay, my antennas are going to be up. But as you mentioned, consumer confidence is really going to be a big driver with flatbed, construction, and of course with overall goods and services.
Great. And what are your expectations for peak season as it relates to domestic air cargo?
Domestic air cargo, I've learned how tightly correlated it is to trucking, surprisingly so. If you had asked me a year ago if I thought that those were tightly bound, I would have said no. What we've learned as we get into data deeper that air cargo and trucking actually are very, very tightly correlated, shockingly so from my perspective. And what we see is that as you see higher demand in trucking, you see higher demand in domestic air cargo and vice versa. There are some segments of the air cargo business which tend to be more volatile. Fresh produce moves by air cargo, and so you have perishables that are impacted by weather more so than you see in the trucking market. But trucking has a lot of exposure to perishables as well. It's just that you have longer cycles, and you have things like electronics and stuff. But frankly, consumers are still buying a ton of electronics and other items. And so it's really watching the correlations between trucking. I would say that I feel as bullish about, and I talked to folks in the air cargo business this past week that talked about their domestic volumes are actually doing well, whereas their international volumes are sort of struggling right now.
Okay. And how much impact will technology have in the freight industry in the coming days with many brokers and carriers using various SaaS tools for tracking and tracing loads? How do you see it shaping up in the future?
Yeah, so if you get into I assume the conversation is around the visibility systems or the ELD devices. I think fundamentally those two things are very similar. I think responding to very similar trends. One is a government mandated tracking, which is the ELD device, and one is sort of shipper mandated tracking, which is the visibility systems. I think, frankly, you couldn't have true visibility until you had the ELD, but with the ELD mandate, you now have the ability for shippers to mandate transparency and still not lose the capacity options. I think that trend's going to continue. I've actually heard that it's no longer about service and the old days, it was about acceptance and how much percent of freight was accepted between a shipper and a carrier. So a shipper would mandate that carriers accepted 98% of the tenders. Now I'm hearing that the only thing that's concerning shippers is that transparency. Is the carrier or the broker willing to offer visibility and tracking? And if they're not, they may end up being removed from the RFP, is what my sources have said.
Okay. Any indicators that broker margins are being impacted by lower commissions being taken by Uber and Convoy?
Fundamentally, I think the bigger risk to broker margins is less of Uber and Convoy. I mean, if you look at the total size of spot freight that goes through brokers, let's use 70 billion, which I believe is Goldman Sachs estimate. Those companies combined are probably around 2 to 2.5 billion. If you counted JB Hunt, you're probably at 3 billion, 3 to 3.5 billion. JB Hunt 360. So right now they're not huge factors. 3, 4, 5% probably on the upper end. I don't think they're really dragging down margins necessarily. I think the bigger risk to the freight brokerage industry is just the fundamental delta between contract rates and spot. Freight brokers have not been able to get, no one in this market is getting contract rate increases. And that is sort of the upper limit. So the larger asset carriers sort of set the market, if you will, in terms of what the contract prices can go. They're not able to enjoy, really any significant, if at all, rate increases on contract rates, which puts an upper ceiling. And then spot rates have bottomed. If you sort of support the thesis that the market's improving, spot rates have bottomed, and what's going to compress margins and brokerage margins is going to be the fact that they're having to pay more for the same trucks that they did in previous months, but not able to pass those cost increases on to their customer. I wouldn't cry if I'm in the 3PL industry, because I probably made a lot of money in the past year as that delta, that spread between contract and spot was as high as it's ever been, or as high as it's been in this cycle for sure. And because of it, I don't think anyone should sort of complain. I do think there's a risk to brokerage margins, because what we probably will see is that that the peak of sort of that spread becomes tighter. The cycles and the delta between contract and spot become more tight as we move into these digital environment.
Okay, great. And what is your take on the FMCSA's proposed 5 key revisions to existing hours of service? And if implemented, what % of increased capacity are you predicting this could inject back into the market?
I actually had Chris Spear in our offices last week, the CEO of the American Truckers Association, Trucking Association, the ATA. And what he had suggested was that this proposal is going to, and there's a listening period, there's a comment period, that we're talking a couple of years before this gets implemented. So any changes to the hours of service regulations are probably a 2 to 3 year cycle. If you've been around the industry, you know that anything that happens to do with hours of service, or safety for that matter, these regulations take many, many years. And so I'm not as close to it as perhaps the ATA, TCA, or OIDA is, for that matter, frankly, the safety and legal and compliance officers in this industry. But what I understand is that we're looking at a couple of years before you see any fundamental change to those regulations.
Okay. And can you please shed some light on why Asian and Mediterranean ocean rates are higher than the rest of the ocean markets?
Yeah, I imagine we're talking about year-over-year % changes. Yeah, I mean, for the U.S. and China, the trade war is really having a tremendous impact on both sides. China's, trying to figure out, who's going to satisfy demand that the U.S. normally would have taken care of for them. You have a lot of these U.S. importers shifting, manufacturing production, kind of like I mentioned earlier. But you're seeing a nice mix, a really nice balance of supply and demand for the ocean carriers in that market. And you're seeing, demand really kind of driving those rates. On the other side, for the Trans-Pacific eastbound to like the U.S., you're seeing rates down because demand's just not there yet. So really, I think a combination of the trade war and then the carriers just getting better at maintaining that balance between supply and demand is leading to those increases.
Great, thanks. And you guys mentioned housing as it relates to flatbed. What is your take on automotive and the consumer in what seems to be a generational shift on the consumer's sentiment toward possible fewer vehicles being owned?
I think that's a fact. I think we've seen peak auto. I mean, I think 2 years ago was really peak auto. And I don't think consumers are buying as many cars. I mean, I talked to a lot of people in the automotive sector, which are thinking about shifting how they're thinking about their demand cycles, and the fact that peak auto is behind us, and that consumers, I mean, you saw Ford and General Motors completely shift their offerings and their product line this past year. And that's just a reflection of consumers' sentiment. Trucks, light truck vehicles and SUVs are doing better and will continue to do better because families still, I think my wife is an example, still wants an SUV to drive my kids around. But I think for commuting purposes, younger people, particularly in the in urban environments, are not owning vehicles. They just don't see the need to go buy a vehicle with these on-demand apps. And I think once we enter in a world of say, intra-city autonomous, sort of low-speed autonomy, then it's just going to become more pronounced. I mean, scooters, this is a story. I was talking to one of our writers today. She actually was doing research on the scooter industry and how much of miles, if you had full implementation around the country of scooters and they started got full consumer acceptance, how many miles it would reduce in urban footprints. And it's actually not insignificant. Yeah, it's about 40% of miles on Uber are actually done on scooters.
They need to do that study in Vietnam.
No comment. So.
All right. For OTR, do you see a shift in more or less dedicated FTL this year compared to last year?
I think dedicated is usually a function of really one or two sort of environments. One is dedicated tends to come up when shippers want to control more of their supply chain. So you've seen companies like Amazon, and I don't know that I'd call that. I mean, it is dedicated capacity. These are dedicated owner operators, but they're not. They're not contract dedicated where you're bringing in an outside firm like a JB Hunt or a Swift to manage dedicated. They're hiring incremental owner operator capacity. Amazon's probably one of the few people that are doing that. But we have seen some increase in dedicated fleets, more related to capacity concerns. I think in a market where capacity is sort of sluggish is that, shippers are not going to go make those investments in this part of the cycle. And so I don't see a ton of demand, sort of incremental demand for dedicated. It tends to be in markets where there's a concern for significant capacity shortage of freight being left in the back, where you see dedicated, or you see environments where shippers are wanting to control more of their delivery cycles or specialized capacity, like you see with Amazon.
Great. And similar to the flatbed question, what are you forecasting for dry van carriers for the remainder of 2019 and into 2020?
I think you had to bifurcate between the larger enterprise carriers that have a lot of exposure to retail and sort of the broader OTR market. If you're in the broader over-the-road market and you're not exposed to retail, which a lot of the spot market doesn't have as much exposure to retail as what some of the larger carriers. I think the larger carriers that have big retail contracts are going to do pretty well this season. I think they're going to have a really good fourth quarter just because there's so. I will bifurcate this or be cautious to say I'm assuming the consumer is going to hold up. I mean, I'm assuming consumer spending is going to hold up, consumer confidence is going to hold up. If that's the case, then I think those larger carriers will do exceptionally well. Retail spending is still growing at a clip. And so I think that will do well. If you're talking about carriers that are in other parts of the freight market that have more exposure to the industrial sector of the economy, they're going to struggle more so. And I think we'll see spot rates continue. I think we've flattened out in spot rates, but I don't think we're going to see any fundamental huge spikes in spot rates this cycle, even if the larger carriers do well. I think they're going to do well, and I think Wall Street's frankly going to be still price their stocks based on spot rates, but they're going to do better. We've seen that before. We saw that in 2015 where the big public carriers did really well, but Wall Street sort of punished them for low spot rates, even though it wasn't really their exposure. I think we'll see that this cycle.
All right. And any insider input you would share around the impact of IMO 2020?
Henry, I'll let you take that in a second. I would say, I don't know that IMO has insider impact. There's a lot of different views. The EIA has said, once the market stabilizes, they project that domestic ULSD diesel costs will go up by as much as 25 cents a gallon as sort of the stabilization. So that will have an impact. I mean, the good news is that diesel prices are, they're sort of stable right now. Oil prices, there's an oil glut. So there's no pressure on oil prices. So I think the market can absorb that 25 cent a gallon increase. I think the bigger question is on the ocean.
Yeah, for the ocean carriers, I mean, they're definitely going to be trying to recoup the costs they incurred. Having to retrofit these vessels, having to prepare for the IMO 2020. So you're going to see the bunker fuel adjustments. You're going to see increases there. No doubt, but global demand, I think, it's not going to be where it is this year. I think for U.S. imports specifically, not looking so great for Q1, Q2 of 2020, especially. There's an early Chinese New Year. So, again, demand early in 2020, I just don't know how strong it's going to be on that ocean container side. But that also plays into kind of the implementation of it. With the U.S., there's an election year. Trump-China trade war. There's a lot of uncertainty in the global economy right now, and I think that certainly has an impact on how this plays out, because if things turn south, the IMO 2020 will be on the table as far as regulation and actually
They may actually pull it back,
enforcement.
right?
Well,
Yeah.
there'll just be some adjustment. I think that's a very real possibility, because I think it would be kind of haphazard to move forward with full enforcement implementation, in a down economy.
All right. We are right up on 3:00, guys. So we're going to go ahead and call it a day for this week. Thank you all for taking the time to listen in. Thank you to Craig, Anthony, and Henry for being here with us today. And don't forget to get your tickets to FreightWaves Live. Join us in Chicago, November 12th and 13th. You can learn more about the speaker lineup, the agenda, visiting www.freightwaveslive.com. Thank you guys for being here. Have a great afternoon.
Thank you.